Half an hour away from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Yep, we're back in the studios today. Good morning. Stocks across the region trading in a very tight range as global stock rally stalling on signs really of, like us, fatigue. In this AI frenzy, the dollar rebounding with traders pairing bets on Fed rate cuts next year.
Investors rushing back really in a big way into Alibaba, making it China's hottest tech stock with fresh plans to boost AI spending and adding further momentum.
Also ahead, China's biggest car exporter, Chery Auto, is set to debut here in Hong Kong this hour after raising more than $1 billion in its IPO.
Plus, a Bloomberg TV exclusive, South Korea's prime minister tells us that U.S. investment projects and trade talks cannot progress until visa issues are resolved.
A very good morning and to all of you. There's really not a lot of consistency across these markets. Consolidating, trading sideways, range bound, pick your adjective and verb. It's also not a rush, certainly, to the exit. So certainly we are tracking the losses overnight, but as you can see, we are already seeing a bit of a floor here on S&P futures that could really all change going into the thick of Thursday. Let's change the page, please. And really, it was the rebound in the dollar, which is petering off, as you're going to see very, very shortly right now. Might be adding to some of the reasons people are taking some risk off the table right now. Dollar yen, as you can see, still on the way to the downside at 10 to 1%. Gold, of course, some upside, although that is, of course, simply reversing the move of about 24 hours back. This is the big one we're tracking, given, of course, that massive move up in copper. And, of course, that is one group of stock you'll be tracking today, following, of course, what took place, the world's second biggest mine. We'll look at what happens, of course, and I'll get you in a moment. Change the page, please. The contract in Shanghai. Okay, big story. Alibaba, more on this in a moment. Baidu, and we're looking now at also gaming approvals, 150-plus titles, the majority of which are local titles, including out of Baidu later today. Massive move up in the Golden Dragon Index up overnight. And futures are indicating, coming up very, very shortly, I promised you copper coming up, come here, brought up in your screens, Steve. And dollar China, there we go. So we are looking at maybe some of these gains from yesterday. Really a manic session yesterday in Hong Kong, of course, to the upside. I think it was 13 billion, more than that as far. Thank you so much on southbound flows coming through the Stock Connect yesterday. So we are going to get maybe a little bit of weakness coming through copper futures, as you can see, playing a bit of catch up to what took place overnight. Yvonne.
Yep, overnight, as you say, right? The cleanup efforts are underway when it comes to Ragasa, and it looks like, signs of us going back to normal, right? And we're starting to see that when it comes to flights, particularly when it comes to the airport. Cathay Pacific, in particular, they're resuming their flights starting this morning as well. But certainly was a storm that packed a punch. It brought us to have to hunker down in Hong Kong at home, Dave. And certainly now the cleanup efforts, right? Whether assessing the damage, that's going to be the next sort of stage here in Hong Kong as this typhoon now moves towards Vietnam.
Yeah, we'll see what happens with that. Certainly, there's a massive backlog of air traffic that we're going to get to as well. So we're waiting for more announcements coming through out of Cathay Pacific. The other thing we want to point out too is, so Chery Auto really on the weather, right? So the debut is still happening, although they've scrapped the ceremony at the exchange, which was supposed to take place today. So there is some disruption, but we'll see what happens with that, of course. And yeah, in terms of pricing, gray market did indicate we might see some upside as far as that's concerned. And yeah, trade numbers, I'd ignore that for now. HIBOR is one watch. So we are nearing that 4% handle on that. So we did not get a setting yesterday because, again, of the weather. Watch that closely. If we do get something north of 4%, that would take you back to almost levels that we saw back in April and in May. We were talking about this. We saw this bicycle story, Yvonne, earlier on.
So David and I, this is what we when we grab breakfast in the morning, right?
Yes,
we talk about
bicycles
and maybe headlines. This is an interesting one, Giant. So they are one of the world's biggest bike makers in the world, right? So the U.S. is to block Giant manufacturing bicycle imports from Taiwan. You're seeing the shares in Taipei now are falling some 9% or more. There you go. We're now about down 6%. So this is what we're hearing from the U.S. Customs and Border Protection. Says its personnel will detain bicycles, parts, and accessories manufactured by the company and imported from Taiwan. We don't know why at this point, but certainly does lead to some more discussions about where trade tensions and the like, and certainly it is impacting even the bicycle manufacturing side of things.
Yeah, that's a big story, no pun intended there, that we'll continue to track going into the thick of things today. But let's turn back to what took place overnight with Alibaba and, of course, this flurry then of changes and upgrades from analysts. Investor interest certainly keeps building as far as the company is concerned. Let's bring in Annabelle Jewellers, of course, our Asia tech correspondent, with all the latest on really what's been suddenly a manic 48 hours here in the stock here.
Well, a manic period, and really underscored, of course. We had that in an announcement yesterday. We can get into more details on it. But essentially, Eddie Wu, the CEO, speaking at a conference saying they're going to go a lot further on the AI spending. We didn't get too many details on exactly what that means in terms of the dollar figure, but in February, you had the companies saying they were going to be spending $50 billion, and they had that goal, that stated goal of reaching artificial general intelligence. And so very ambitious plans and really putting it on the map on a global scale as well. And you saw that, I mean, it's been a huge tear for the company. If you look at where we've been month to date, for instance, it's the top performing name on the Hang Seng Tech Gauge, a rally of around 50%, and you compare that against the peers of like Baidu, for instance, another name where you're having a real rethinking around its AI efforts and its AI ambitions. SenseTime as well. I mean, it's just sort of that broader AI theme that's also starting to expand further now because you've seen that big rally also in the semiconductor ecosystem as a whole, not just names like SMIC or Huawei, but it's also the chip equipment makers, for instance, as well, that are really catching on in this. And it all comes back to, that, again, that self-reliancy and that push for China really to be at the forefront of AI.
And it's become almost the stock to play when it comes to China's AI boom. What are analysts saying about it now? A lot of upgrades this morning.
I mean, yeah, upgrades. And I think if there was sort of one theme that came across from the likes of Morgan Stanley, Citi, Jefferies, UBP, is that Alibaba's AI models are really world-class. And they were very optimistic on those in particular. UBP also made the point that you only start to have those spending upgrades when you're quite confident of ROI. So just to recap again, so the company's already committed $50 billion. Yesterday, Eddie Wu, the CEO, said that globally you're going to see $4 trillion of spending on AI in the next 5 years, and so they want to extend even further to keep pace. I do want to pour a little bit of cold water on it from our Bloomberg intelligence team, because they continue to make the point that Alibaba, yes, they're spending really heavily, and you saw that in the latest earnings, for instance. Their cash flow outflows turned negative, so you actually saw so much spending on AI, I think $5 billion in that quarter alone. ROI, though, I mean, from the AI models alone, it was around $400 million. So yes, it increased, but it's still far short of matching that huge amount of spending. And that is something you see globally. It's not just, of course, an Alibaba story.
I think it's the whole narrative of being that whole full stack AI services provider,
and that comes into, because now they're in the chip space, they're going in-house on that, and they've got their models, they've got the cloud, you know, and we saw that announcement yesterday. They're taking that cloud into all around the world, you know, so it's big, and that's sort of the play, I guess, and why investors are so optimistic on this company.
Well, thank you, Annabelle Jewellers there, our Asia tech correspondent. Let's bring in Jason Lui, head of APAC Equity and Derivative Strategy at BNP Paribas. Thank you so much for coming into the show in our studio after this massive storm. It seems like a storm around Alibaba in a good way, right? It's finally making this comeback, it seems, and it's become the big ton of tech darling. How do you look at this whole AI advancement in China right now? And how do you compare it to what you're seeing in the U.S., for example?
I think if we take a step back and think about AI investment as a whole, I think there are probably two interesting, separate but interconnected themes happening. First, you have this U.S.-driven AI optimism that naturally feeds into Asia thanks to the supply chain connection in Korea and Taiwan, and that's quite well understood. But even for a market like Japan, over the past few months, it seems to be benefiting from that. We actually estimated that more than 60% of the Nikkei rally since June could be attributed to just 10 stocks that are heavily related to AI and semiconductor. Now then, when you look at the Hong Kong-China space, it tends to operate in a slightly different frequency. I think Annabelle brought up about this kind of renewed optimism on AI. And we saw that earlier in Q1, right? You may recall that during Q1, we have that similar moment with DeepSeek, but then it kind of fizzles out. And then when it comes to the summer, you had this hardware versus software split as well, because during the summertime, leading up to the military parade, there's a lot of optimism in the China onshore market where the semiconductor makers, equipment makers are doing quite well. Whereas the Hong Kong market has been under pressure because investors were worried about this delivery battle that may have pressure some of the internet companies' stocks price. And after that earnings, you almost have a clearance event, and then all of a sudden, that narrative shifted from worries of delivery price war into this kind of AI full stack investment scheme. So I think it's an interesting evolution that the Hong Kong space is now catching up to the rest of the world when it comes to AI optimism.
How much of this rally is down to the fact that, I mean, to your point, we're playing catch up. You know, markets were massively underweight the AI theme in China, and now suddenly we're waking up to announcement after announcement. In other words, short term, does it matter whether or not these companies can actually deliver ROI?
I think it's a great question that increasingly investors are asking, and I think that's probably happening more in the U.S. now that you have more and more of these very big investments being announced. I think when it comes to the Hong Kong-China space, we're still at the early stages of that. I think what we noticed is that during the recent earnings in the summer, many of the internet companies did mention that they are seeing good monetization rate of their AI application. Perhaps to Anna's point, it's not quite meeting the lofty expectation on day one, but it seems that at the moment, most investors are thinking 2 to 3 years ahead. And previously, I think they were concerned that whether or not China can even achieve self-reliance technology. I think that part has been resolved. So it makes it easier for investors to project what could happen in the next 2 to 3 years, assuming that they can start monetizing these technology over time.
Yeah, a lot of the what's driving this rally in China seems to be the tech sector still. How are we looking at valuations right now among the tech space? Is it looking a bit too expensive, and where?
Sure. I think we can divide it into two parts, the software part and the hardware part, because they trade in slightly different dynamics. If we look at software, let's say Hang Seng Technology, for example, we're now trading roughly 21 times forward earnings, which is quite a meaningful rebound versus perhaps the start of the year. But then it's still below its 4 or 5 years average, because back in 2021, we're trading much different dynamics.
Yes.
And when you compare to, let's say, U.S. peers, say NASDAQ's trading roughly 27 times forward earnings. So I think from a software perspective, the Hang Seng Tech is still relatively, appealing compared to the U.S. peers. But if you look at hardware, let's say the China onshore semiconductor-related names, we have a basket of China semiconductor equipment maker, and those baskets are trading roughly 40 times PE, so that's much higher. But then I think when investors are investing in these themes at the moment, they're perhaps looking at 2-3 years ahead rather than this year or even next year, because the base for Chinese domestic substitution is so low that if this substitution were to happen, then I think that non-linear reaction will likely kick in year 2 or year 3. So perhaps that's why investors are still willing to pay a relatively lofty valuation for these hardware stock, at least in the onshore market. There was
a moment last week, I'm not sure if you saw that, the Huawei announcement on Thursday, and they outlined this 3-year plan. Short of the description was basically, this is the path to catch up with NVIDIA. Is there any reason to doubt that China will be able to catch up in terms of being at the forefront of technologies as it pertains to the NVIDIA story?
Sure. I think from a China perspective, there seems to be this kind of collective effort. Beyond the company you mentioned, recently we also had the Global AI Conference in China, where all the global AI leaders also came, and they also demoed some very impressive technology around that as well. So perhaps it's not a company-specific issue, but rather the entire supply chain. We have seen even internet platform companies are now jumping into the custom chips, which is something that the global peer has been doing. So I would imagine that by collectively upgrading the entire value chain, it is possible to do the whole full tech stack on their own. But it will take time, because it is the first time that China is trying to achieve this kind of level of sophistication when it comes to technology.
Quick question for you then. The bar seems very low for investors to become impressed by any sort of, and I mean, I'm tempted to add an I in between my A and V, just so I become an AI too. How do we distinguish hype at this point in time? Or does that question not matter still?
I think it depends on which market you're looking at.
Hong Kong. Let's talk about the Hong Kong software.
Yeah, sure. I think on the Hong Kong side, the investors are probably still looking for revenue opportunity.
Okay.
They still want to see that what kind of new tools companies can introduce to really amplify the revenue with AI. I think the profitability question will come. I agree, because the number is starting to get quite big. But because the starting point is so low, that having some tools that they can monetize, it's already quite encouraging compared to where we are, let's say, a year ago.
Okay. Jason, of course, will be staying with us. Lots more to talk about as it pertains to this Chinese equity market, head of APAC equity and derivative strategy there at BNP. Coming up here on shows, our exclusive with the South Korean Prime Minister after hundreds of Korean workers were taken into custody following a raid on a U.S. battery plant.
Realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. we absolutely must find a solution. Several projects are underway between South Korea and the US. Without resolving the visa issue, meaningful progress remains virtually impossible.
Right, welcome back. We're about 2 minutes into the announcement of the midpoint for the day here. There we go, bottom of your screen, 7-11-18 versus the estimates. And we have, in fact, there we go. We have actually reversed most of the weakness in the futures market as we move into, of course, the pre-markets in a couple of minutes here.
Yep, we'll continue to watch what happens with Alibaba and the like here. Are we set for some sort of cooling period after the surge in the ADRs and what we saw in Hong Kong yesterday as well? Still with us is Jason Lui, head of APAC Equity and Derivative Strategy at BNP Paribas. Let's kind of move the whole Alibaba tech story aside and really talk about this kind of slow bull market that we're seeing in China. People were expecting this press briefing on Monday to maybe have some sort of policy or stimulus. We didn't quite get it. But you said there was more that came out of this briefing that maybe investors overlooked. What is it? Yeah.
That's right. I think if I go back to your earlier point, why were people expecting some stimulus? Because if you look at the title of that meeting, it's supposed to be a recap of the 14th five-year plan. So supposed to be backward-looking. But because of the people who are attending that meeting, you have the heads of all the financial regulators.
Yes.
It gives people the memory of this time last year,
yes,
the same group of folks actually introduced something quite meaningful. So even though the subject was backward-looking, there was some expectation of a forward-looking statement. And it's interesting that Pan Gongsen, the head of PBOC, said at the very beginning, today's about the recap. So I think that kind of set the expectation. But what is interesting is that once we start listening to the CSRC chair, Wu Qing, he actually gave a few very interesting comments. Yvonne, you mentioned about slow bull market. In fact, I think the definition of slow bull market is quite vague in China because we're so used to boom-bust cycle. We're not used to slow bull market. It's something that we'd love to see, but we don't have enough historical evidence. So when you dig a little bit deeper into Wu Qing's comment, he made a few very interesting points. Number one, he actually said that the realized volatility of Shanghai Composite Index during the 14th five-year plan has declined by 2.8 volatility point. This is highly unusual for regulators to give you such a specific comment when it comes to market volatility. And this feeds into our idea that perhaps what the regulators are going after is higher volatility adjusted or risk-adjusted return. And if you look at the major indices in China this year, let's say CSI 300 or CSI A500 index, their volatility adjusted return is actually even better than S&P 500. So perhaps we need to change our mindset a little bit. It's less about the absolute return. It's more about your return divided by the risk that you're taking, that you can draw in more investor into this kind of slow bull market.
Right. And that drop in, let's call it actual, was that by design or is that something that they can target as an objective, for example? What would be the best leading indicator, basically, if that is what we're supposed to be paying attention to moving forward?
Sure. I think there may be 2 or 3 ways to look at this. Number one, we have seen concrete action from the government to lower the downside volatility. If you may recall, over the past year or so, the national team has been a lot more active when it comes to ETF purchases. And it's to our understanding that they tend to step in when you have a major negative shock in the market. And we have seen something similar, right? The Bank of Japan, at the start of Abenomics, also have achieved something like that, where they go through this ETF purchasing program to reduce the so-called equity risk premium in the market. I think the other one to look at is what the markets are projecting going forward. So as the structural volatility of the market continue to go down, the options market will also likely to price in lower volatility going forward as well. And that seems to be true in both the onshore market and the offshore market, even for Hang Seng Tech, for example.
So what's sort of the advice now? How do you still participate in this rally, and how do you express kind of the optimism around things like AI and the like now?
Yeah. I think one interesting phenomenon happening in the Hang Seng technology derivative market is that what we call low but expensive optionality. It sounds counterintuitive, but let me explain. Low means that the absolute level of volatility is quite low. So at the moment, the short data volatility in Hang Seng Technology Index is roughly 30 points, which is low by historical standard, below its 2-year average.
Okay.
But when you compare to what has happened, i.e. the realized volatility, it's still quite rich. So you get into a situation, if you buy these options outright, you may be overpaying for the potential distribution of these indices. And so instead, what we have noticed is that our clients are switching into the so-called call spread strategy, where you can lower the cost but still maintain the upside participation. And this type of strategy tends to work quite well in a market like right now, where the absolute level of volatility is drifting lower, but it's still quite expensive to hold it outright. So by doing a combination, you are maximizing your return on your premium.
Right. Should these conditions continue? Is there any reason to believe that these investing conditions will persist over the future? In other words, will the trade still work as more people perhaps correct the price into where it should actually be?
Sure. I think there will be eventually this convergence of implied volatility versus realized volatility.
Okay.
And it could happen when you have these market shocks. For example, I think Yvonne brought up earlier about the Taiwan export situation, that it's a good reminder that there's still some unresolved situation when it comes to global trade. Yeah. We know that U.S.-China is still going through the negotiation. We know that there's still other M&A deals that's going through. So I think there's still plenty of event catalysts on the horizon. And that is why using options rather than simply buying it outright can give investor a better risk-reward profile that way.
There we go. That's where Jason and his team, of course, come into play. Jason, fantastic. Thank you so much for coming here into our studios today. Jason Lui, their head of APAC Equity and Derivative Strategy at BNP Paribas. Just, in fact, on the note that Jason was just making there, right, the fact that the national team is in, we actually have a very good piece out. This is for our Bloomberg clients. You can read all about it. You'll see it coming up on your screens very, very shortly. There we go, right? The national team and the purchases, $50 billion. A lot of that, of course, is via these ETFs. You can read all about that story coming up very, very shortly.
All right, we're checking two big stocks here this morning. Alibaba is certainly the one to watch. We're unchanged in the pre-market, but there you go. Chery Auto, first day of trade there, and we are seeing a pop in the shares about 11% or more. No gong ceremony, as we've been told, due to, of course, the typhoon and the like here. But yes, this is after raising 9 billion or so Hong Kong dollars in that IPO. We got plenty more ahead. This is Bloomberg. All right, analyst actions today. It is all about Alibaba, right? Take a look at what Citi, what Barrett and Huatai has done overnight. So ADRs from Citi have been upgraded, really on the back of what they're saying is a tenfold increase that they're expecting when it comes to data capacity and rising AI cloud demand.
Well, let's see if they're correct this time. Because certainly the fact that you have a massive delta in those price targets effectively is an admission that, oh, we didn't see this one coming.
Yeah.
And we need to adjust it. But, you know, who knew anyway? Like the typhoon yesterday.
Yes.
Feel still a bit salty about what happened, but yeah, anyway.
Yeah.
We needed to do what we needed to do.
Okay, but certainly that's one to watch here today. Whether it seems like in pre-market we're unchanged right now. We'll see how the rest of the day goes here. But certainly, is it time for a bit of profit taking on this trade? Stocks to watch as well. We're watching Chow Tai Fook Services. Some news there when it comes to the company. So the stock is now up 2% after proposing an issuance of bonds. They're up to 2.2 billion Hong Kong dollars. And we got a Chery Auto debut. Looks to be a pretty good one. This is Bloomberg.
Right, welcome back. You're watching the China Show. We're going into the open today. So yes, for one, the market was open yesterday despite the typhoon. And not only was it open, it had a stellar session, massive inflows across the stock connect. And today we're looking at this debut of Chery Auto, which early indications suggest that we're going to get a massive pop at the open today, up 11% in your pre-market. Apart from that, mining stocks, we're looking at green energy, we're looking at game makers as well, gaming companies, among the many. There's this busy news flow going into the Thursday session, Yvonne.
Yeah, no shortage of news, really, when it comes to these markets here today, as you mentioned, right? So Chery Auto, we'll talk about that in just a bit, but it looks like the pre-market has been looking pretty good when it comes to the first day of trade here. Of course, they are one of China's biggest exporters, the OG of really automakers here, but not a pure EV play. So we'll see how investors look at this stock. But the gray market was looking pretty good yesterday here as well. Onshore markets are looking like this here right now, so we're pretty flat when it comes to Shanghai as as well as in Shenzhen here today. We're watching copper very closely here after, of course, that Freeport-McMoRan accident, that force majeure. So that certainly is impacting the copper price here this morning. So we're seeing some of the futures in China up some 3% here. We're also watching when it comes to crude. We're up 1.5% this morning as well. So onshore markets are doing okay. Not much movement here when it comes to bond markets, but we're watching very closely this kind of reversal in the dollar, right? The strength that we've seen has really kind of put this renminbi rally or strength really hitting the skids right now. We briefly touched that 714 level just overnight. Let's flip the boards and show you how things are looking at when it comes to the currencies. So a lot of talk of whether this sort of catch-up rally to the dollar with Treasury yields, can that actually last here? But we're still talking about 713 levels for renminbi. Honky dollar still looking a little bit strong as well. We're still at that 778 levels this morning. But we're focusing very closely on tech, right? So Alibaba, there you go. We're still extending some gains, but, yesterday was the big one after, of course, what we heard from their very own tech conference here of them really throwing a lot of money into this beyond just that $50 billion target that they had when it comes to AI spending. So it looks like we're still seeing some legs in this Alibaba rally. This is after we heard from the likes of Citi upgrading the ADRs and really talking about this potential, right? They're expecting a tenfold increase when it comes to data centers and even just for when it comes to this whole AI cloud demand. So there you go. Alibaba's up just around that 175, 174 level here right now. Baidu is interesting. We're up 1.6%. So gaming approvals came through. I think more than 150 games that were approved from regulators overnight there. And Baidu is actually one of them. So there's actually that element to the whole Baidu story as well, not just when it comes to AI, where Tencent, Alibaba, as well as Baidu have become the AI darlings in some ways. But there's a gaming element as well. Tencent, though, is heading the opposite direction. Flip the boards. We're watching, of course, copper stocks, as we talked about with what's going on in Freeport-McMoRan. So we'll see how some of these local miners are doing. There you go. CMOC is up some 11% here right now. Jiangxi Copper also up some 9% and following the price of copper. And there you go. Chery Auto. I'll leave you with this. So no gong ceremony today. This is that one day after the typhoon, so potentially that's why they did cancel that ceremony. But it looks pretty ceremonious here today. There you go. 10% pop for Chery Auto.
Yeah, I mean, I'm sure issuers that don't get this nice first day pop would rather they get this than showing up and having that banging of the gong. Best day on record for Chery Auto, of course. Just the latest of, again, many companies hitting this market to raise cash, and in their case, of course, they'll be using that in terms of R&D. It's also a good reminder for markets and investors to really brush up on Chery Auto, right? A company that's been here, has been one of China's biggest car exporters for many, many years, decades, in fact, if you trace it back to the early 2000s. In fact, there you go on your screens, right? It's at the very top. We keep focusing on some of these startups, well, newish EV players like XPeng and NIO, but yeah, this is really one of the OGs in this market. So according, in fact, to Frost and Sullivan, actually here, the automaker has remained, in fact, at the very top, the top exporting brand every year for the last 22 years. Let's get more with Bill Russo, founder and CEO of consulting and investment platform Automobility. Bill, good morning, and thank you for taking the time to speak with us again. You remind investors, if they're buying into this IPO, what exactly are they buying? What kind of automaker are they buying here?
Yeah, I think you described them as an OG. Yeah, they've been around a long time. I've been in China for 21 years, and I've known them right from the beginning. With my early days at Chrysler, we had conversations with this company. They are a traditional company. They are, I would call them legacy companies that have been making gasoline-powered vehicles for a long time. But for many years, Chery actually sold more cars outside of China than they did inside China. They have well-established distribution relationships with countries all around the world. They're selling in over 100 countries. They still predominantly sell gasoline-powered vehicles, which around the world, that's still the predominant form. But they're also the number 6 in China company overall and the number 4 company in new energy vehicles. So they're an up-and-coming entrant into the new energy vehicle race, but they're well established in the gasoline-powered, and that gives them a leg up on competition. If you're fighting in a race with EV-only startups, you have this dual-track strategy that you could play on, where you can continue to milk the old cow, combustion engine powered vehicles, especially in markets which still primarily demand those, while you invest in creating the portfolio of new energy vehicles, which is what they're doing with the IPO.
Yeah, and it's interesting, right? When you look at the markets that they do export to, I think what struck me was that Russia was one of the key markets after its largest single market after China. So it seems like right now, though, there's a bit of a reset when it comes to exporting to markets like Russia, like Iran, like Cuba, that might face some regulatory risk and the risk of sanctions. What do you make of this sort of move? Is it a strategic move, and how are they going to fill the gap, and whether markets can actually fill that gap?
I would say it's opportunistic. They pivot quickly. They just opened up a strategic partnership in Iraq with Jamil Motors, which is a Saudi-based distributor. So they have, and this is, I think, to the flexibility and the speed at which Chinese companies can pivot is amazing. They're not afraid of going to the emerging markets. I think the global automakers tend to prioritize the big, and obviously Chinese companies would like to be in the big European markets where there's better margin opportunities, but they're not afraid of taking those beachheads in smaller markets. So they will go to the global south. They will focus on and have Latin America, Middle East, and other places around the world to build up scale. That gives them the ability to compete at scale and at cost, and then that gives them the entry point to enter the bigger markets in Europe.
Bill, what's interesting about an example like this where you have a company, to your point, maybe part legacy, it's been around for a while, but it's just now listing, is a lot of people for the very first time get to see the financials of the company. And I wonder, if the temptation for the company to use the money it's raised today to compete for the future in EVs, do you think that would be a smart strategic decision on the part of the company to compete head-to-head with the likes of the XPengs, the NIOs, the BYDs?
Well, they've been in their prospectus, they've been earmarking how they're going to use the funds. Now, their aim was to raise $1.2 billion at around a $22 billion valuation. That puts them ahead of other EV startups like NIO and XPeng on total valuation. So they clearly are getting capital markets to recognize what they have here. What they also disclosed is that they're intending to use 35% of the proceeds for new market development. And that's indicative of the kind of company they are. They are the #1 exporter of made in China products, automobiles around the world. The second on the list is BYD. But Chery's #1. It has been for a long time. So 35% is to grow the scale of the business in the international markets. 25% is to be allocated to next generation smart new energy vehicles. And the balance will go into continued investment in overseas expansion and upgrading their Wuhu base, which is their home operation. So they have a very clear idea what they want to do with the funds. They've been very clear on the priority being to scale the business in the international markets.
Bill, if you had to take your pick in terms of the EV space or the auto space in general in China right now, what stands out to you, right? I think what really shocked the market a few weeks ago was the fact that the #1 in the EV space, BYD, is the one that really is suffering in terms of earnings now because of the price wars, because of what we're seeing competitively. How do you look at the whole EV space moving forward in the next 3 to 6 months?
Yeah, I think there's a class of competitor, BYD, clearly in the lane of I scale first and I defer profits to when I've squeezed out competition. The ability to compete in the future of mobility, especially new energy vehicles, is a race to scale. I would say companies like BYD clearly are going to be able to scale in the high-cost components, and particularly the batteries. That's their DNA. Chery is leveraging its ability to build at low cost. They are originating from a lower-tier region. They prioritize their ability to sell into lower-tier regions of China. That's been their DNA from the beginning. And they're going to leverage that by going into these emerging markets and competing on price with a mixed portfolio of new energy vehicles, and eventually, but initially as gasoline-powered vehicles. That's a lane of competition. Now, there's another lane of competition, those are the super scalers, I would call them, BYD and Chery being clear examples of that. And then there's the lane of technology competition. That's where Xiaomi lives. That's where companies like Li Auto and NIO and XPeng live. Those are the two emerging lanes of competition coming from China.
Bill, final question for you. You know, you speak with a lot of American companies, of course, involved in China's car industry. People talk about, and they seem to focus on the fact that Chinese names are competing with foreign names. But when you look across that supply chain, are there opportunities in that Chinese auto supply chain for foreign companies to get involved?
I think that is the way forward for the global auto industry. Unfortunately, we've conflated geopolitics with economics in a way that's detrimental to the sustaining business performance of the global auto industry. There's no road to the future of electric mobility that doesn't, at least for the near term, engage at a level the Chinese supply chain. I would argue it's not just about the acquiring batteries; it's also the power electronics that are needed in the vehicle. You need to build them at large volumes in order to drive down cost and price competitiveness are going to be essential if you're going to compete in the future of mobility. That's going to include Chinese companies going global. So the future of the industry depends on finding a way to leverage the scale of markets like China for your competitiveness going forward.
Bill, thank you, sir. Bill Russo there, founder and CEO of Automobility for us. Going into the session today, just a reminder, of course, because of the weather yesterday, we didn't get a HIBOR setting. Want to watch because we're knocking on the door of 4% for the first time since May. And really, this is really one of the last things this struggling property market really needs here in Hong Kong. Again, higher borrowing costs and higher mortgage rates, what have you.
Yeah, we'll see if that changes how things look, right? Certainly, it has been a bit of a comeback when it comes to HIBOR. HSBC, meanwhile, it's a perfect segue to this, is really having to take, well, said to have taken the unusual step of pushing its Hong Kong subsidiary Hang Seng Bank to offload portfolios of bad real estate debt. Now, this comes amid concern over the city's struggling property sector. Let's get in our China credit reporter, Trista Luo, who's here to tell us more. It's an unusual step, but tell us why it's unusual.
Yeah, so we haven't seen this before. HSBC, which owns 63% of Hang Seng, right now is directly involved to push the Hong Kong subsidiary to offload its bad real estate debt. And we know heard from sources is that Hang Seng's right now are considering to sell 3 loan portfolio, which are valued at more than $3 billion. So that's a massive number. And sources are telling us HSBC is basically not satisfied with Hang Seng's current approach to deal with its NPL portfolio. Basically, they are relied more on individual relationship with those private lenders and other key institutional players and deal with those assets on an individual basis. So what HSBC wants is more a holistic approach and try to, sell it in a more systematic way. So right now, Hang Seng is also in talks with some consulting firms.
I could be speaking to you soon. I think you guys might have moved the market.
Yeah.
So Hang Seng Bank's down, down quite a bit, outpacing these losses. So what's next here? What do we need to watch out for?
Yeah, first of all, we definitely need to watch how well the HSBC directive will be followed, right? Because Hang Seng is already being in touch with some private lenders, and some of them already signed NDAs. So we need to see how this whole discussion goes. And secondly, I think more importantly is how the Hang Seng's move will impact other banks in Hong Kong. Because last week when we reported that Hang Seng is already, considering sell some portfolio which worth more than $1 billion. And some bankers from other banks already told me it's like a bond to the market. So they might need to relook their own book, and some of their property assets might need to go through revaluation. So that's something we're looking at now.
Okay, going to keep you busy for sure. Trista, thank you so much. Trista Luo there on the HSBC Hang Seng and the dynamic change between the two there. Staying on HSBC, and the bank says it has achieved, get this, a world-first breakthrough in deploying quantum computing in financial markets, if the two things weren't hard enough to understand already. One senior executive describing it as a Sputnik moment for the industry. The lender says it's used IBM's most advanced quantum processor for a 34% improvement in predicting bond prices. Well, something's got to help. It's the first time any bank has used real trades at scale to demonstrate the edge offered by the emerging technology. All right.
Sputnik moment.
I didn't understand what I just read there, but anyway, plenty more ahead. This is the China Show. Right, welcome back. Now, South Korea's Prime Minister says investment projects in the U.S. will remain in limbo until this visa issue is resolved. Now, the two countries are working to revise the visa system after hundreds of South Koreans were detained earlier this month in that raid in Georgia. Kim Min-seok told us exclusively that the incident's also casting a cloud over talks to finalize a trade deal later this year.
This negotiation wasn't initiated by us. We didn't start from a position of advantage, nor did we raise the issues. Isn't that the case for the entire world? Since the whole world is negotiating under the new conditions presented by the United States, rather than insisting on specific conditions, the correct answer would be that certain things are simply difficult to achieve. Therefore, anything that exceeds the limits of what the Republic of Korea can bear in terms of national interests, acceptability, capacity, or public understanding will be quite difficult to undertake.
Are the issues that need to be resolved around the $350 billion investment fund into the U.S.?
That's generally the case, since the framework for the large amount is already set. The fact that the amount is fixed means it started with the expectation that depending on how that amount is structured, it could potentially be mutually beneficial. However, the structure itself, how the funds are raised or how the profits are distributed, these things need to be within the bounds of what's considered normal. And when explaining to our Korean citizens, it needs to be at a level where they can understand and accept it. Above all, it must be within the capacity of our Korean economy to handle.
When it comes to the tariff themselves, we still have to see the U.S. actually lowering car tariffs on South Korea to the agreed 15%. And even if the tariffs were lowered, the tariff advantage that South Korean car makers had over Japan, for example, 2.5% before the Trump trade deal, that's going to disappear. How painful is that for South Korean firms right now?
First, the FTA structure between us and the U.S. is changing, and that will create a burden. Naturally, if tariffs drop from 25 to 15%, that will be better, but it's still harder than before, and especially at this point. There's the difficulty of having to bear the 25% until this negotiation concludes. So, in short, there are difficulties. Hyundai Motor and others are facing particular challenges. However, as far as we understand, Hyundai Motor currently plans to navigate this situation without changing its pricing policy for now. I personally view this as a relatively wise approach. The government is reviewing various policy options to see what can be done to alleviate the burden on the automotive sector caused by the ongoing negotiations.
More problematic also for Korean companies has been the visa issue, especially with the plant in Georgia. What sort of resolution can we expect on that front?
Before discussing what kind of solution there is, realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. We absolutely must find a solution. Several projects are underway between South Korea and the U.S. Without resolving the visa issue, meaningful progress remains virtually impossible. The detention incident dealt a severe blow not only to the general Korean public, but especially to the workers who were actually detained. In the absence of firm assurances regarding their safety, both they and their families are understandably reluctant to enter the U.S. again while this matter remains unresolved.
Are investment projects right now halted until some resolution is acquired on the visa issue?
Although the projects have not been entirely halted or formally placed on hold, it will be very difficult for a large number of workers to enter or re-enter the U.S. until this problem is resolved.
South Korean firms are also seeing challenges, for example, in China, especially when it comes to U.S. chip restrictions for Beijing, Korean firms operating in China. How can South Korea manage the growing tech rivalry between China and the United States?
That's a problem the whole world is grappling with. It's a natural concern, especially for countries like Korea that share significant economic ties with both the United States and China. Naturally, we strive to maintain good relations with all neighboring countries. However, we understand that the overall plate we stand on has tilted slightly compared to the past.
In what way?
The terrain itself has tilted towards strengthening our relationship with the United States. I can answer it in that way.
There we go. Wide-ranging conversation with Chery there out of South Korea. Plenty more ahead. This is Bloomberg.
All right, we're watching CATL shares here right now. The 8 shares are heading to a record here after what we saw that JP Morgan upgrade on talking really the strong earnings outlook, right, when it comes to ESS demand, energy storage systems, and really their earnings estimates now are the highest on the street.
Okay, yeah, there we go. Really one other market to watch here as well. Some of these miners, we'll get to that in a moment. Plus, of course, these announcements coming through here on the bond market on both sides of the border. Maybe a push here in Hong Kong and, of course, more on the mainland. Plenty more ahead. This is the China Show.
Welcome back to the China Show. We're glad to be back at work as well after we were hunkered down.
I'm not actually.
Are you not?
I'm exhausted.
I'm exhausted, but God, I got to get out of the house, man.
Oh, yeah.
I was stuck with 3 kids working from home in my living room. Yes.
Well, some of our viewers might have caught a glimpse of that.
Oh, I wish we could read. Yeah.
This time yesterday.
Hurricane Mom. One of my friends called me. She says you should be a meme. It shouldn't be me. It should be my son. But there you go. Hang Seng is trimming some of these gains here as we speak. Perhaps the Alibaba story. Yeah, it was so much optimism yesterday, despite what we saw with that storm. That's cooling off a little bit as well here this morning.
Yeah, I think we hit an 81 or 82 on the 14-day RSI of Alibaba. Certainly a lot of catch-up, of course, out of analysts on the sell side, upgrading their price targets in the stock here. I'm just look a quick glance at the stock itself. And, of course, other things as well taking place on the back of, well, business as usual, right? So Alibaba's up 1%. We're trading at about 176 on that. Other things of note, you have, of course, CATL. We talked about these upgrades coming through. And we're looking at now on track for a record, right? On the 8 shares specifically. Chery Auto, that's the big IPO here today in the city. We talked about Baba and, of course, Hang Seng Bank to the downside. Perhaps on the back of this Bloomberg are reporting here that HSBC is looking at its unit, Hang Seng, to help clean up, of course, some of the bad debts on their books. The other big story overnight was the force majeure, of course, world's second biggest copper mine, and that really led past tense to some big gains in the price of copper overnight. We're seeing that bit of catch-up in the Shanghai contract today. Equity plays on your screens shortly. In fact, right now it's coming up copper prices, iron ore, and, of course, you have steel and Shanghai crude also coming up on your screens. There we go as far as copper goes, 3% to the upside. And, of course, some of the game makers here. We're not talking about the casinos. We're talking about the actual computer games. Tencent, Baidu, and NetEase. There we go, 145 plus 11, that takes us to about 156, if my math is correctly. That's basic arithmetic. I don't know. Well, that underscores, I guess, how fatigued we are here. 3% to the upside on shares of Baidu.
Yeah, that's interesting, the gaming element for that company in particular here.
Yeah.
It really was kind of benefiting from the whole AI wave that we're seeing alongside Alibaba here as well. Let's bring in Mark Cranfield, our Bloomberg MLA strategist. He joins us from Singapore. Mark, it's great to have you. And you know, let's start with what we saw with Alibaba, right? You know, certainly it seems like, as Dave mentioned, right, any sort of mention of AI spending And these markets just go euphoric in some ways, and Alibaba has been a key beneficiary. But, you know, where are we in terms of the stock? Have we reached a peak? This cooling off period, how long can it last?
Yeah, I think when you consider the huge amount of money which was flooded into Alibaba and some of the other tech-related companies on an AI story, and you saw overnight Oracle issuing a huge bond amount, one of the biggest ever, that was subscribed about 10 times over. That money is probably going to find its way into building AI data centers and those kind of things. So the whole story is getting a bit euphoric. When you consider that we're pretty close to quarter end now, and then China's going to go into a long holiday immediately afterwards for National Day, there are signals there that might take people pause a little bit here. Let's stand back a bit and take a breather, because this has been an extraordinary run. Doesn't mean to say that we can't do nicely in the fourth quarter as well, but in the very near term, it's all looking a little bit frothy and as though people need to calm down a bit. And there are a couple of warning signals out there. If you look at Ether, for example, in the crypto space, as markets were really rebounding nicely from the Liberation Day sell-off in April, Ether was one of the leading crypto plays. That's clearly starting to top out now. It's getting quite close to the 4,000 level. If it dips below there, you could see a pretty broad sell-off across the crypto space. That may well feed into equities as well in the near term as well. So there's a few cracks starting to appear, at least, that would make people think, okay, we're coming to the end of September. Maybe it's time just to book some of these profits. So it would be a bit surprising if we saw the likes of Alibaba and Tencent really extend their gains too much until we've seen a little bit of settling down first.
Mark, we also woke up to this big move in the dollar overnight. I mean, that could be one of the pain points. Could is the operative word there. What do you think was the catalyst there for this move in the dollar on Wednesday?
In the very near term, that was just a backup in Treasury yields. The auctions this week have not gone as smoothly as expected, so short-term yields are a bit higher in US. That usually quickly translates into a bid for the US dollar. Again, positioning towards the end of the third quarter. People would have been a bit short US dollars, probably covering some of that as well. The read across from crypto would also be slightly bullish for US dollars. It's probably a near-term positioning thing, people just readjusting. It probably doesn't have major significance. Also, some of the Fed speakers this week have not been as dovish, maybe as people expected. They probably were thinking that once the Fed speakers come back after last week's rate cut, they would have been more aggressive in selling the story that rate cuts are coming. The market's still pricing for lower interest rates from the Federal Reserve this year, but not quite as aggressively as they were a week ago. So all of that plays into the near-term mood. It's probably just a blip. It's unlikely that the big theme of a lower US dollar is really going to change very much. If you look at the euro, it's still around 117. That's the first place that people will look. If they want to know where the US dollar story is, they'll be looking at the euro cross. Unless we see a major change there, then people will be expecting the US dollar to gradually ease lower into year end.
Mark, thank you so much. Mark Cranfield in Singapore for us. Let's continue the China part of the conversation there with Mark just now. As this market comes back alive, a lot of interest is certainly circling around this equity market. Morgan Stanley says its research team had some recent conversations with U.S. clients and have revealed really investors expecting this divergence between Chinese markets and macro environment to continue. Chetan Ahya is here with us, Chief Asia Economist at Morgan Stanley, recently back, of course, from a U.S. trip. Chetan, very nice to see you, sir. Interesting, the title of the report and the choice of words, what we debated with U.S. investors, not what we discussed with U.S. investors. Give us a sense of what that dynamic was like and that debate.
Yeah, so I think first up, I should say that it's a pleasant change. When you would go in the past to the U.S., there will always be a lot of concern on investability in China. That issue did not come up in a single meeting, so that's a pleasant change. The other interesting thing I learned is that there was a clear distinction between understanding on macro developments as well as market developments. The concern that we all have on China economy, China deflation, that is well appreciated. So there was not much debate on the outlook of China's macroeconomy. But there was a question whether, when can you really have that divergence where economy is not doing well, deflation is exerting pressure on corporate profits in aggregate, but can the markets do well? And that's where I sense that their conclusion was that, yes, markets can do well because we have a completely different set of ideas there, particularly like how you see in the US, right? The Mag 7 is doing well. The broader economy has not been doing well more recently. And same way they're thinking about China, that there can be stories in China which are worth investing and that can diverge from the overall macroeconomic scenario.
There's still a lot of debate about whether China can exit out of deflation. And I think you guys still feel like there's still a lot of lingering pressures when it comes to deflation here right now. But what's the take on whether anti-involution, is that going to be enough to lift the economy out of deflation? And what's needed for that to actually succeed?
So we are still skeptical that current form of anti-involution policy on its own is going to be sufficient to get China out of deflation. Just think about the fact that why we got here. We have this deflation challenge in China because policymakers are trying to focus on a GDP growth target, which is right now 5%, and you are having this massive structural decline in the property sector. So when you have that hole in growth, because of property, they want to try and bridge that gap with more investment in manufacturing and infrastructure. And that's creating this problem of excess capacity and deflation. So if we truly want to fix that deflation challenge, we think that a few steps are needed. Number one, they need to accept lower real GDP growth, maybe 3.5%, 4%. Number two, they need to generate that 3.5%, 4% GDP growth with more consumption rather than investment. Because even if lower GDP growth is achieved with more investment, you still have that problem of excess capacity. And in some of the sectors in manufacturing, we know the excess capacity is huge, like 50, 55%. Whether it is solar, batteries, EVs, even legacy nodes, semiconductors. So there needs to be a pullback in that investment growth-driven GDP growth, maybe for 2-3 years.
Yeah.
And then that can help improve that dynamic of capacity utilization and get us out of that deflation challenge.
Part of where some of that excess capacity has been used for is really in this pickup in exports again. Yeah. Should that remain, in other words, if you're an emerging market economy, should you expect more Chinese imports to come in? Also developed market economy. Europe, for example. Is that a feature, now a feature, not so much a bug?
No, I think that's definitely going to happen, and let's accept it. Some of the stuff that China is making now, particularly the sectors that I mentioned as excess capacity, are precisely the sectors which emerging economies as well as Europe needs those products. Let's take the example of India, right? India needs that for all the products that I mentioned, which China has excess capacity to meet its energy transition needs. And moreover, India also needs the capital goods for those sectors. And China is, again, the only country which can supply the capital goods related to those sectors. So I think emerging markets are going to take it. The only challenge for those emerging markets, particularly, I would say, ASEAN, is that they don't have the domestic demand strength to offset that pressure from imports from China. And that's why it's becoming more challenging for them. And we've seen what happened in Indonesia. And it is precisely because you're seeing a lot of pressure from China in all of these ASEAN economies in terms of the underlying wage dynamics, labor dynamics, and that's a challenge that these economies have to face.
Is there also a silver lining to all of it, too, that it's actually putting downward pressure on inflation, that China could be exporting that as well?
Yeah, that's true. It's happening across the region, and we have in our report done an analysis. So what we did is we looked at, first of all, aggregate PPI in region ex-China. It's very highly correlated with China. And China, in fact, leads regional PPI dynamics. So the whole region is facing this disinflationary pressure because of China. One other study we did is we looked at every component in India. In India's WPI, they call it WPI instead of PPI, and then match it with China's PPI segment-wise. And we found a very high correlation in a lot of the components in Indian WPI because of this, the disinflationary challenge which is going on in China. It is being transmitted to the whole region.
The question around to your point, China might need to be used to lower growth. Do you think the job market will remain stable at a 3.5% level? Because that seems to be the question. Yeah. You answer that, then probably 30% is okay.
No, that's a very, very important question. And so we thought through this issue, and that's why what we are recommending, Robin Ching and I both are on the same page on this solution, is that they have to target on social security reform. And if they can increase their spending on social welfare, particularly related to migrant workers, there are 300 million of them. It's bigger than a country like Indonesia in size. So, and the saving ratio for this population is currently sitting at over 45%. National saving ratio in China is at 31%. So if you can spend on social security related spending, then these households can reduce their saving ratio. That can give you a better multiplier effect in form of consumption. But while you are generating this lower growth with consumption, if you're targeting towards that social security benefits, then it addresses the issue of social stability as well. So I think that's the reason why the solution that we are recommending, we think is probably the best solution for China.
Chetan, thank you. Chetan Ahya there. He's staying with us from Morgan Stanley. Still ahead on the China show. We'll have reaction as President Xi tells the UN that Beijing aims to cut greenhouse gas emissions by up to 10% over the next decade, a target many see as too modest.
And I'm Stephen Engel in Hong Kong, which is counting the cost from yesterday's super typhoon, which raked the city, causing significant damage to a number of businesses, including here in the satellite town of Tung Kwan O, where a number of restaurants were damaged. I'll have the full story coming up. This is Bloomberg.
Welcome back. You're watching the China Show. We're back here with Chetan Ahya, Chief Asia Economist at Morgan Stanley. Just to continue the conversation on China. So, Chetan, the question, so markets have been rallying on the back of this premise of liquidity, and people look at that savings, that mountain of savings of Chinese investors, and saying that seems to be enough. And I can't help but think of, the rally is taking place maybe because the economy is weak, not despite of it. In other words, that's where you get the returns. And I wonder, from a policy perspective, the temptation is introducing short-term measures to boost confidence, but they're introducing many things, right? Silver economy, some very slow-burning reforms on Social Security, for example, and these are things that will not mature and bear fruit overnight. So in other words, is the market just set up for disappointment because they're waiting for short-term results for a longer-term exercise that is needed?
Yeah, I think that the long-term reforms are necessary, and our view is that the pace is relatively slow. They can definitely do it at a much faster pace.
Okay.
But it's just that they are stuck with a few framework issues. So I think number one framework point that they have, and in my discussions, that's what I said, is that whenever there's a downturn in the economy, you have to support that downturn and revive growth with investment. Because if you leverage to invest, you are creating assets for the future. Whereas if you leverage to boost consumption, you're only leaving debt for future generations. So that's intergenerational transfers for them. So they're holding back for that. Number two is that they think that, because their total population is declining now, even working age population is declining, how do you generate real GDP growth? Per capita income is still low relative to developed world. You want GDP growth to be there. But if your population is declining, now GDP growth has to come from productivity growth. And how do you generate productivity growth? With investment, not with consumption. And the third thing they were thinking is that you cannot increase structural commitment in government expenditure to defend a cyclical slowdown. Though my concern is that this is not a cyclical slowdown. There is a structural slowdown because the property sector is not coming back. And therefore, we need a structural solution of Social Security reform.
If we do get that paradigm shift, in terms of this evolution of the economic framework. Is there a trade-off that is not too obvious right now? What do we perhaps need to give up economically?
I think what they need to give up is, very high real GDP growth, and then take a backseat a bit in terms of investment. And maybe it comes at the cost of some slowdown in tech innovation or innovation in all those sectors. But I think it's what is necessary. It will be good for China in the long term.
I want to talk about more of risks ahead, maybe potentially. In your trip, you actually talk a lot about the business cycle and how most people that you talk to are quite constructive on growth. But what about when it comes to tariffs? How should we be looking at tariffs towards the end of the year?
So call me like the last bear sitting on the tariff impact in this whole
Well, it
war.
depends what you say next, but yes.
No one's talking about
I
it
am
more,
still
really,
concerned about the damage that comes out of tariff. And I think in my conversations with the U.S. investors, even Asia and Asian investors, they've all sort of moved on. They think this is like a gone story. It's not relevant. And I think it is. It is still relevant because, for Asia particularly, tariff rate has gone up from 5% to 25%. Just because I know with certainty what is the damage doesn't take away the pain. I mean, it can't be that the pain is not there. It's there. And what we were expecting for some time is that there is front loading. Yeah. And so eventually there is going to be a payback. And the payback will probably be bigger because you have done the front loading. There is an underlying slowdown in the U.S. economy. So you are going to have a bigger slowdown in trade in the coming months. And guess what? The September data point, which we saw for Korea for the first 20 days, if you adjust it for holidays, it's down by 10.6%. So we're beginning to see that. And I suspect that you are going to see that more in the coming months where trade slows down in the region.
And that's already, to your point, Korea, which has sort of the AI semiconductor tailwinds going with it. What about the rest of the region? Like how bad does it get?
I'm talking about Korea, and Korea tech exports also slowed, by the way, because a lot of the Korean tech exports is also not going for just AI, it's going for the broader economy. Right. So that is also probably slowing down. That's what Korean data is showing. But the rest of the region is going to suffer even more because they don't even have any exposure to AI in terms of their exports. And so we are expecting that the whole region will see a meaningful export slowdown in the coming months.
And so you think more cuts coming through from Asia central banks then?
Absolutely. We discussed about the disinflationary pressures from China. Starting point of inflation is already low. You're going to see domestic capacity utilization suffer because the trade slowdown comes in. So we are expecting more rate cuts than what the market is pricing in right now or the consensus is talking about.
I'm curious what you think. You mentioned Indonesia earlier on. I mean, we've seen tension around inequality and just maybe overall inflation. And do you think around the corner we're underestimating the potential for a policy shift in many of these places in EM? How are you guys at Morgan Stanley looking at this sort of broader conundrum?
I think that
on the fiscal side of things, and just
I think precisely. I think not only China, but the whole region will need to do a lot more on the fiscal side. And we didn't discuss about AI, and that's coming as well, and that's going to have additional, job pressures in the region. We can already see that in the U.S. in terms of youth unemployment issue, and I think that's coming also to the region. So they will need to have a proper planning of how to address this challenge of, colored inequality, unemployment, not only broader unemployment, particularly youth unemployment. There needs to be an active planning needed. And I think fiscal policy is right now not actively being used. And more of the economies in the region will have to do that.
Okay. Certainly that's one thing to watch. India, though, everyone's talking about tariffs, as you mentioned, that we haven't quite felt maybe the effects of that yet. India markets certainly have been sort of on the weaker side because of the headlines. You're still thinking that a recovery is underway. Why?
Yeah, so India has two issues. One is that there was a domestic slowdown that was taking place. If you look at corporate revenue growth, earnings growth, that has been already showing. Yes, the GDP growth numbers have been strong, but if you look at the nominal GDP growth, that has been quite weak, and that's what matters for the corporate sector. So I think that major reason why Indian investors have been concerned about India is precisely that. the domestic slowdown, and then overlay that with this trade tension. So that's the second issue that is affecting India. Now, on the trade tensions part, we are currently expecting that it will be resolved in 2-3 months' time, and that's what we have built in our numbers. And that's a risk to watch. We cannot with certainty predict where U.S. policy is going to evolve on that. But I think to the extent to which a bigger reason for India's sort of so-called underperformance versus the rest of the EM is domestic demand story.
Yeah.
That is definitely turning up. And if you look at the first 2-3 data of the festival day season, and I hate to look at like high frequency data to make a medium-term call. But the numbers have been so strong for credit card sales, auto sales, that we think that domestic demand is beginning to turn now.
Chetan, thank you so much. Chetan, Ahya there out of Morgan Stanley, which covered just about everything there. Plenty more ahead here on The China Show. All right. The copper story is continuing to give here, and you can read the full story, of course, on what's been taking place in that massive mine, of course, in the accident there. But it's leading to higher copper prices, and that's leading to this follow-through effect in the equity market. Right, so we're just going into the Japanese lunch break, and just to mention that the big item on the macro agenda in Japan today is this 40-year bond auction. We'll get more on that in a moment. We're looking at slight upside in the equity market, which really wasn't the case, or at least we were thinking that today was going to be more of sideways trading. We are coming off the bottom as well across some of these markets. Let's see what happens. U.S. futures have found an anchor going into the thick of Thursday, so we'll see whether or not that actually continues to give. Of course, the other thing, as we change the page, please, if we can here, is this move up in the dollar and this backing up of yields and leading to where you are on dollar yen. As we mentioned, a 40-year bond auction is coming through. We're now looking at, let's call it 335, 337. As far as the bond yield is concerned there, it's worth pointing out as well, we're backing up a little bit, right? So I think it was late May and early June where we had some issues getting these auctions out. There were concerns, obviously, about this melt up in yields. But since then, a lot of things have taken place. For one, you look at how the 40-year bond auction has gone so far this year, bid to cover on the right side of your screens. You also have, of course, the supply dynamics helping things along. You have Tokyo proposing to actually decrease the issuance of super long-term government bonds by $670 million, enhance liquidity to certainly auctions for the coming auctions, not maybe so much today, but that certainly plays into likely demand because of the decreased supply moving forward. You have the Ministry of Finance coming out and cutting the issuance for debt to more than 15.5 years and beyond, and less than 39 years at each of those bond auctions as well. It's also worth pointing out that foreign investors have been fairly active in this market amidst this pickup in yields. I think we're now 8 straight months through the year, January all through the end of August. They've been net purchasers, net buyers, net inflows into the JGB market. That's just to say, maybe we shouldn't be worried too much over this coming bond auction in the next hour or so than we used to be just as recently as, 8 to 10 weeks back. Anyway, just to pivot the story here, we're looking at shares of Giant. That's the bicycle maker, of course, in Taiwan, following, again, what's really coming as a big surprise, of course, is pullback in the U.S., coming under U.S. scrutiny. The other thing we're tracking as well, you have Alibaba and, of course, you have Chery Auto, which is the big listing here today. No ceremony because of the weather, but this listing did push through, Yvonne.
It did. It looks like it's working out for them in terms of Chery Auto. They were up some 10%. Still watching for Zijin Gold for next week as well, and how long that delayed, the typhoon delayed that listing. Now to the latest when it comes to, of course, Tropical Storm Ragasa, which has weakened from a super typhoon level as it moves towards now northern Vietnam and threatening to drench the capital of Hanoi with heavy rain. At its peak, Ragasa was the most powerful storm recorded anywhere in the world this year. And it did kill at least 17 people in Taiwan when heavy rain caused a natural dam to overflow. Hong Kong Airport, meanwhile, says it expects to handle more than 1,000 flights on Thursday. Flights in and out of Hong Kong were halted, as you know, for 36 hours as the typhoon lashed the financial hub.
Yeah, let's bring in Stephen Engel, our Chief North Asia correspondent. He's out and about in Hong Kong right now, just having a sense of what took place as the dust settles here. Steve, tell us what you see and where you are.
Well, obviously, Hong Kong is used to typhoons, and the cleanup happens pretty quick. It's happening here already, even though it doesn't look like it started. It has. This is kind of a collection of everything that was on this restaurant patio. 3 different restaurants are here, and these are the storm barriers. They are actually blown over, as you can see down here. There's some steel that slats in here. The storm surge pushed it all and broke through many of the windows. Many of them were taped up, but of course the tape just prevents the glass from flying. It doesn't hold back the storm surge from Junk Bay, which is just off here. We won't make the cameraman turn around because we're in the bushes here, but essentially that's what was the problem for this location. It's southerly facing, and the storm, Ragasa, basically it passed by Hong Kong about 100 kilometers to the south. So everything south-facing really took the brunt of it. But I have to emphasize as well that Hong Kong was extremely lucky. You just mentioned, Yvonne, about this being the strongest tropical storm, or the strongest storm on record anywhere in the world this year. But it wasn't as damaging as that other T10, that's the classification of the level of storm. T10 in Hong Kong is the highest level, and we've had 2 already here in Hong Kong this year. In 6 decades of records, Hong Kong has never had 2 T10s in the same year. In fact, dating back to 1946, there have been 19 equivalent T10s. So we've had 2 already this year, something, the scientists will like to look into about global warming and all that. I won't go down that rabbit hole right now. But essentially, one of the reasons why this one wasn't as damaging, perhaps, as Mangkhut, another 10 in, 2018, was that had a more loose eye. The outer eye then was more strong, and it really pummeled Hong Kong. This one that passed yesterday had a real tight eye, and the outer edges were less powerful, even though it had essentially the same path, skirting off the coast of Hong Kong to the south, and not hitting land, basically hitting Hong Kong with a full brunt. But again, it was at the outer edges more loosely defined, and therefore less structured and less powerful. So that's my basic layman's weather report there. But again, the big lucky thing is that there were no deaths. Yes, there is a mother who fell into the water with her child. They were unconscious when they were pulled out of the water. She is said to be still in critical condition, so we'll be watching that. But essentially, Hong Kong is familiar with these typhoons. They tape up their windows, they hunker down, they go to the store, they buy up toilet paper, water, and everything, and we are just waking up to relatively lower damage than previous T10s.
Yeah. Thank goodness for that, right, Steve? Of course, we were just talking about how we were all hunkered down as well. And obviously cleanup efforts are underway, but it seems like this Ragasa is not quite done, right? We've talked about how it could continue to barrel southern China, Vietnam next. What we saw in Hong Kong, is that a clear indication of what's going to happen to the likes of Vietnam now?
Well, it did hit Guangdong after Hong Kong, so more of a western Guangdong. There are several million people were displaced, and it's hit the landfall. So it's had landfall. So typhoons weaken considerably when they hit landfall. So there will be some damage, obviously, in Vietnam and going inland, but it does weaken quite a bit. I'm not there, so I can't give you firsthand knowledge. But again, today here in Hong Kong is about getting those flights going again out of, Chek Lap Kok Airport. It was closed completely for 36 hours, so that's a bit of a headache. And also just counting up the costs for businesses and also homes that might have had damages. The last question, I broke down some of the damages compared to Mangkhut. Well, Mangkhut had nearly $500 million in insurance claims, so it was quite a powerful storm. This one already, Bloomberg Intelligence is sort of looking into the cost to insurance companies. It might be around 50 to 100 million, so about a fifth of the cost of Mangkhut. But again, we're in preliminary stages right now. But again, I guess you could call this a lucky blow to Hong Kong because it could have been much worse.
Steve, thank you. Our Chief North Asia correspondent there joining us from Cheong Kwan O. one of the worst hit areas yesterday as well. Of course, this brings to mind a lot of discussions about climate, and really China's climate targets are a key focus when it comes to Chinese media today, with the People's Daily headlining President Xi's UN speech, setting a goal of cutting net greenhouse gas emissions by between 7 and 10% over the next decade. Now, it's a plan that some analysts say is too modest to put the world's top polluter on the path to net zero. Let's bring in our China correspondent, Min-seok, on the target, how realistic, and how much more does it need to do?
Well, according to our in-house analysts, they have put out a model that suggests that China needs to cut carbon emissions by about 40% or so by 2035. And you look at China's target now, 7 to 10% cut, they say, is too unambitious. But bear in mind that China has this tradition of setting pretty modest goals and then exceeding it. And you look at its target to, for example, peak carbon emissions by 2030. If the current trajectory doesn't change, it suggests that China might have already peaked carbon emissions last year, 2024. That's 6 years ahead of schedule. Also look at how China has been pouring a lot of investments into renewable energies that has been, at record highs in the last couple of years. It's still possible that China could be on track to reach its net carbon neutral goal by 2060. Another thing that is significant here is that China is moving away from this intensity-based approach to cutting emissions to an absolute amount, and that is in line with developed countries as well.
Well, speaking of, I can't help but compare this side by side with what the U.S. is doing, almost on the opposite side of things.
Yeah, and, there's always been this comparison between U.S. and China, of course, especially with President Trump having pulled out of the Paris Climate Agreement in his first term in office. And President Xi also made a veiled swipe at the U.S. without name-dropping the country. He said in this televised speech that you can see here, a pre-recorded speech at the UN Climate Summit yesterday, and saying that, some countries, he said, are going against this trend of a green transition, and that the rest of the world need to remain unwavering in their commitment here. So China has been filling in this gap, the leadership gap that has been left open by the U.S. when it comes to climate, as well as when it comes to global aid, for example. And Chinese state media, as you can see earlier on the People's Daily piece, they have been really highlighting the fact that China is now taking the lead when it comes to these climate change agreements.
Min, thank you so much. Min, our China correspondent there. We will leave you, and Min was just mentioning your pre-recorded speech out of Chinese President Xi Jinping in front of the UN. Of course, we'll leave you with some live pictures out of the Chinese president attending the 70th anniversary of the establishment of the Xinjiang Uyghur Autonomous Region. Plenty more ahead. This is Bloomberg. Wait, I'm doing this. All right, welcome back. We're looking at, who would have thought? We were looking at, well, just to rewind, an hour and 40 minutes back when futures got underway. Solidly in the red. We reversed most of that going into the open. Still red. Open flat sideways, and as you can see now, at least on the onshore markets, has completely just reversed that, 0.5%. In fact, just yesterday, it's worth noting, the CSI 300 already closed at the highest since early 2022. The same can be said when you look at the small caps index. So we mentioned this in the agenda going into today. Really watch. A lot of attention was on Alibaba. Also look at what happened onshore yesterday, and it's continuing today on the Starboard and the Star 50 index, and the Chinex index were up about 1.6 as far as that's concerned. So yeah, we'll continue to track this. And large and going into some of the tech plays as well. Yeah,
Alibaba's up 1% right now. That's why your HS Tech is up by 0.9%. It's the chip makers, it's the Hua Hong Semis as the leader of the board. Now we're seeing 6% gains for that Hua Hong stock. So there you go. It seems like momentum is building once again in China. Let's talk a little more about South Korea. The President Lee Jae-myung has reportedly met with U.S. Treasury Secretary Scott Bessent in New York. Now, the Chosun Daily says Lee explained to Bessent how South Korea's economy differs from Japan's as the two countries work to finalize their trade agreement. Now, the Prime Minister, Min-seok, also spoke exclusively to Bloomberg about the latest on those trade talks.
This negotiation wasn't initiated by us. We didn't start from a position of advantage, nor did we raise the issues. Isn't that the case for the entire world? Since the whole world is negotiating under the new conditions presented by the United States, rather than insisting on specific conditions, the correct answer would be that certain things are simply difficult to achieve. Therefore, anything that exceeds the limits of what the Republic of Korea can bear in terms of national interests, acceptability, capacity, or public understanding will be quite difficult to undertake.
Are the issues that need to be resolved around the $350 billion investment fund into the U.S.?
That's generally the case, since the framework for the large amount is already set. The fact that the amount is fixed means it started with the expectation that depending on how that amount is structured, it could potentially be mutually beneficial. However, the structure itself, how the funds are raised or how the profits are distributed, these things need to be within the bounds of what's considered normal. And when explaining to our Korean citizens, it needs to be at a level where they can understand and accept it. Above all, it must be within the capacity of our Korean economy to handle.
President Lee talked about the need for a currency swap agreement in order to avoid any shocks to the Korean economy when delivering these funds. What has Washington said so far?
I haven't heard the exact details yet on how they've responded so far. However, as the president has already stated, that amount currently represents 70 to 80% of Korea's total foreign exchange reserves. Without measures like swaps or similar mechanisms, the impact on the Korean economy will be too severe. Also, as a nation that had experienced a foreign exchange crisis, public vigilance on this matter is high. I believe these factors must be taken into consideration.
When it comes to the tariff themselves, we still have to see the U.S. actually lowering car tariffs on South Korea to the agreed 15%. And even if the tariffs were lowered, the tariff advantage that South Korean car makers had over Japan, for example, 2.5% before the Trump trade deal, that's going to disappear. How painful is that for South Korean firms right now?
First, the FTA structure between us and the U.S. is changing, and that will create a burden. Naturally, if tariffs drop from 25 to 15%, that will be better, but it's still harder than before, and especially at this point. There's the difficulty of having to bear the 25% until this negotiation concludes. So, in short, there are difficulties. Hyundai Motor and others are facing particular challenges. However, as far as we understand, Hyundai Motor currently plans to navigate this situation without changing its pricing policy for now. I personally view this as a relatively wise approach. The government is reviewing various policy options to see what can be done to alleviate the burden on the automotive sector caused by the ongoing negotiations.
More problematic also for Korean companies has been the visa issue, especially with the plant in Georgia. What sort of resolution can we expect on that front?
Before discussing what kind of solution there is, realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. We absolutely must find a solution. Several projects are underway between South Korea and the U.S. Without resolving the visa issue, meaningful progress remains virtually impossible. The detention incident dealt a severe blow not only to the general Korean public, but especially to the workers who were actually detained. In the absence of firm assurances regarding their safety, both they and their families are understandably reluctant to enter the U.S. again while this matter remains unresolved.
Are investment projects right now halted until some resolution is acquired on the visa issue?
Although the projects have not been entirely halted or formally placed on hold, it will be very difficult for a large number of workers to enter or re-enter the U.S. until this problem is resolved.
South Korean firms are also seeing challenges, for example, in China, especially when it comes to U.S. chip restrictions for Beijing, Korean firms operating in China. How can South Korea manage the growing tech rivalry between China and the United States?
That's a problem the whole world is grappling with. It's a natural concern, especially for countries like Korea that share significant economic ties with both the United States and China. Naturally, we strive to maintain good relations with all neighboring countries. However, we understand that the overall plate we stand on has tilted slightly compared to the past.
In what way?
The terrain itself has tilted towards strengthening our relationship with the United States. I can answer it in that way.
What does that mean for China-Korea relations then?
I think China understands this too. If Korea, standing on this larger terrain, demonstrates appropriate efforts to maintain its relationship with China, understanding the changed terrain, then even on that terrain, Korea can still strive to maintain its relationship with China.
But the U.S. has had so many demands for South Korea, including, for example, raising defense spending, 5% of GDP, as for NATO, for example.
With respect to defense spending, I do not believe it must necessarily be considered in connection with our relations with other countries. Rather, it is an area that can be expanded as part of strengthening our independent national defense.
By how much?
Recently, we mentioned 3.5%, and we did so because we judge that this is a level we are capable of sustaining.
Are we expecting any contact between North Korean leader Kim Jong-un and President Trump during the upcoming APEC summit?
Both of them are currently evaluating the relationship between the two parties positively. Since unforeseen events can always occur, I believe we should keep that possibility open. But so far, North Korea and Chairman Kim Jong-un are showing no signs of changing their stance.
President Lee created a positive foundation for South Korea-Japan ties during his last visit to Tokyo. We might see a leadership change in Japan. Could this have an impact on Korea-Japan relations as well?
We hope that won't be the case. We believe it is undesirable for relations between nations to be significantly impacted or altered by changes in leadership. While we also face various challenges, we have prioritized diplomatic continuity and are working to further improve relations with Japan. Regardless of who becomes Japan's new prime minister, we expect and hope that they will consider various factors to ensure that the current, newly formed friendly atmosphere is not adversely affected.
South Korean Prime Minister Min-seok there speaking exclusively with Chery in Seoul. And of course, if you are a subscriber and want to rewatch that interview, you can watch us through the interactive TV function TV Go. You can also become part of the conversation, send us messages, questions for our guests throughout the shows as well. Check it out at TV Go. In some other news this morning, China's Commerce Minister has urged Chinese firms operating in the U.S. to avoid bringing so-called involution or cutthroat price wars abroad. Wang Wentao told companies at a New York roundtable that the ministry will strive to stabilize China-U.S. economic and trade cooperation. He also pledged to safeguard Chinese firms' rights amid rising protectionism. And of course, we're also watching robotic stocks in China. The Trump administration has launched investigations into imports of robotics, industrial machinery, and medical devices, setting the stage for fresh tariffs. The investigations are under Section 232 of the Trade Expansion Act. Rather than the emergency powers being challenged in the courts, new tariffs could come in addition to country-based levies already in force.
Right, Chinese top car exporter debuting today. Quite a good one last week. Check. Chery Auto, first day at school here in Hong Kong. CATL also very much in focus.
Yeah, we are rising close to a record high in China on the strong battery outlook. The upgrade from JP Morgan here as well. So there you go. We're up 4% for the A and H shares here right now. Daiwa has also been talking about battery outlook is good because of ESS demand there, right? So they are seeing some investors rotating out of EV stocks into battery. Now, that's it for us here in the China Show. Insight with Haslinda Amin is next.